The following podcast was recorded on Tuesday, April 15th, 2025, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or biancoresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim will discuss what happened to bonds last week. Jim, the 30-year yield rose 46 basis points last week, ending at 4.87%. This was the biggest weekly rise since April 1987. At the time it's recording, the 30-year yield is at 4.77%. So what happened last week?
Yeah, it was epic. So you didn't see that kind of move very often when we've seen what happened with the 30-year yield. And there's been a lot of discussion about this idea that it was a positioning thing, that the basis trade was being unwound. I'll get into that in a second. Or the Chinese were selling. I'll get into that in a second. Or anything like that. My position has always been, or I take the view, just not to use the word position twice, that positioning never creates a trend. Something else has to create the trend in order then for positioning to be caught off sides, like the basis trade or the Chinese, and then they sell and then the move gets exaggerated. So when you look at this chart, the first thing you say is there was an exaggerated move last week. So how did people get caught offside? So let's go to the next chart. Next chart is the average tariff rate in the United States. Is calculated by the Tax Foundation in blue. And Bloomberg Economics does an estimate of what the average tariff rate is going to be as of yesterday. And it's going to go from 2.4% last year to 22.8% this year. By the way, JP Morgan has done a similar calculation, has come up with almost exactly the same number. So almost a 10x rise in imports, in tariffs on imports to the United States. Now, this is going to have a profound change in the way we view things. If we go to the next slide shows you in blue, this is from the University of Michigan's Consumer Confidence Survey. They do also ask, what is your expectation for inflation rates over the next year or so? And what it tells you is they are expecting the inflation rate to be 6.7%. The orange is the gasoline price. And the gasoline price is still not going up. In other words, what usually happens with the one-year forward inflation rate is it follows whatever gasoline prices have done. It's not. It's had a gigantic jump because people expect a big price increase from tariffs. Not just the public. If we go to the next chart here shows us what Wall Street expects. So this is a regularly forecast update of 70 Wall Street economists asking lots of questions. I pulled out what's your second, third, and fourth quarter year-over-year CPI estimates. You can see if you go back around the election, they were down in the low 2s. Now they're pushing well above 3%. Their inflation forecasts have gone up over 100 basis points since Trump got elected. Again, this is on the idea of inflation. So inflation is coming back in some kind of way, and that's what I think has really thrown everybody off sides.
What happened to the Fed put?
So yeah, now if we go to the next slide, the Fed put would be that whenever things get messy in the economy, the real economy, you can expect the Fed to step in. And we've got it messy in not only the real economy, if we look at this chart here, this is those same Wall Street estimates for consumer spending. It's going straight down, especially the orange line, which is what they expect year-over-year change to be consumer spending in the third quarter, and that's July through September. It's really taking down. And if you go to the next slide, their GDP forecasts are coming down fast too. Why? Prices are going up. If prices go up, you're going to demand less, you're going to consume less units. Spending is going to go down. and so is GDP. And the stock market's down, and we had the biggest move in bonds in the last many, many years. So you would ask the question, this is it. Look at the GDP chart. The Fed's got to cut. Not only has the Fed got to cut, but the Fed has got to cut immediately, like intermeeting and the like. But that's not the way that the Fed is looking at it. So if you go to the next chart, the next chart here is a couple of statements by Jay Powell. Let me start with the bottom one. Last 2 Fridays ago, April 4th, our obligation is to keep long-term inflation expectations well anchored and to make sure that there is not a one-time price increase so that the level does not become an ongoing inflation problem. Let me translate for you. We just showed GDP is going down. We just showed inflation is going up. We've got the stock market wobbly, correcting 20%, the worst week in bonds. What's the Fed trying to tell you? Inflation's what matters. We're not going to do anything about all that other stuff. You might be screaming, you being the general market, Fed, cut, print, cut, print, because we've got a problem here. The economy's going down, the markets are wobbly, because that's what you do every time that happens. They're saying, nope, not this time. It's about those inflation expectations. We're going to hold the line. He also threw this out in his March press conference. A great example is washing machines were tariffed in the latest round of tariffs and prices went up. But prices went up on dryers, which were not tariffed. So the manufacturers, just are just kind of following the crowd and raised it. That's the definition of unanchored inflation. Give me a reason to raise one thing, and I'll raise the price on everything. That's what they're worried about right now. That's why stock market could go into the toilet, economy could go into the toilet, people could lose jobs. I'm trying to say this emphatically to get my point across. But if that inflation rate stays up, they're not moving. And that threw everybody for a loop. If I go to the last chart of this section here, this chart shows you the probability that the Fed is going to cut rates on May 7th. Look, it's bad now. It's bad now. What are we waiting for? There's only a 20% chance they're going to cut rates in May. Now, Wall Street will tell us that no, they're going to cut rates later this year when things get worse. No, they're going to get worse both ways. Maybe the economy gets worse, but once those tariffs kick in and once those prices go up, we're going to see even more inflation than we have now. In May, it's going to go higher in June, it's going to go higher in July. That unless the economy goes so bad that, and I don't think that's the case, that it will completely offset the rise in prices with tariffs, it's going to be harder to raise rates in June and July because the inflation situation is going to be worse.
So Jim, who's selling?
That's a really good question. So if we go to the next chart, let's start with everybody's favorite conspiracy theory is the Chinese. So if we look at this chart here, it shows you the dollar index in orange and the dollar index in blue and the 10-year yield in orange. Now they usually track each other. When it used to be when yields went up, the dollar was more attractive because you got more income by holding dollar assets. When yields went down, the dollar was less attractive because you got less income from holding dollar assets. But that broke in a big way last week. Yields went straight up, dollar went straight down. Now, if we were to go to the next chart, what that will show us is a table. While that was happening, the 10-year and the 30, this is through Friday, the 10-year and the 30-year went up big, 18 basis points and 28 basis points. But I used all the 10-year European bond yields. The German Bund down 10 basis points, Spanish Bonos down 7, French Oats, 10-year French Oats down 6, Italian BTPs down 6.5. So what this looks like is with the dollar movement and with these yields, somebody was aggressively selling the United States treasuries, probably out of Europe, because the euro soared the most of all the major currencies, and the dollar fell the most against it, and was heavily buying European bonds. Okay, but I thought it was the Chinese that were sellers. So we go to the next chart. The next chart shows you the Chinese holdings of securities for China in red, 760 billion, Belgium in orange, 377 billion, and Luxembourg, 409 billion in blue. Now, if you go back to like 10 years ago, Luxembourg and Belgium were almost non-existent. What happened was in 2014, Russia invaded Crimea. We, the United States, said we're going to sanction Russia. Oh, the Russians hold $170 billion of US Treasuries in the custody account for foreign central banks at the New York Fed. Let's freeze that. The Russians, before we had a chance to freeze it, withdrew all that money out of the foreign custody account. And a week later, it came right back into the foreign custody account in the Chinese account. In other words, they pulled their money before we could sanction it. They cut a deal with China to warehouse it, and then China put it back into their account. We didn't have a beef with China at that point. That was a message to China and Russia: you better hold your securities in a place we can't sanction them. So over the last 10 years, maybe half or a little bit more of Chinese securities are held in legal entities in Belgium, which is the home of Euroclear, the bond clearing organization, and Clearstream, which is another competitive clearing organization in Luxembourg. So they put them in those legal entities. We in the United States can't sanction them. They're European legal entities. And Europeans aren't going to do it on our behalf because they're mad about tariffs anyway. So is China selling if it's showing up as European selling? Maybe. I don't know for sure. Nobody does. But the answer is maybe, because they own hundreds of billions of dollars worth of Treasury securities. Now, there's the plausible argument. Treasury Secretary Bessent came out in an interview the day before we're recording and said they have no evidence of sovereign selling, meaning that governments are selling. Okay, does that mean that they're not, or does that mean that you just haven't found any evidence of it? Because they don't have to tell you, and it's not immediately clear if that's what they're doing. So one possible person that is selling is China. The other one is, if we go to the last chart, the last chart here shows you the basis trade. And what the basis trade is showing us is that there hasn't been any movement in the leveraged selling of futures traders. So everybody's talking about the basis trade is long cash, own Treasury securities, short futures, and that trade is being unwound. There isn't any evidence that it's been unwound. The prices aren't moving, the open interest isn't moving, the positioning isn't moving, although the positioning was from a week ago. It was from April 8th. This Friday, we'll get it from April 15th. So maybe that's happening, but in the swaps market, there is some movement going on there that maybe it's happening there. This is the problem with positioning. Positioning is very difficult to figure out real time. Months later, we could probably figure it out because there is some data. So let me back up and let me review what we're talking about. What changed is tariffs. It produced sky-high inflation expectations. Maybe they're transitory or one-off, but Powell even pointed out when we tariff washing machines, they raise dryers, and that's unanchored inflation. And so the Fed is saying inflation expectations are going up. Good luck with your recession. We're not cutting rates. I know that's kind of cruel to say it that way, but I want to get my point across. And since they're not cutting rates, that threw everybody for a loop. Wait a minute. We own bonds. When things go messy, the Fed cuts rates and there's a giant bond rally, but now there isn't. Oh, they're worried about inflation. Get out. The leverage traders, the Chinese, everybody else said, wait a minute, this isn't the way it's supposed to work. They exaggerated the move. So now where are we left? We are left with a market that is worried about high inflation expectations. Oh yeah, you could point to the CPI and PPI numbers last week were very good. You could tell me that the PCE number next week when they release it is going to be very good too. Wall Street's very good at estimating it once they get PPI and CPI. And I would say none of that matters. That's an old world. It's called the pre-tariff world. Nobody cares what happened with inflation. We're talking about the post-tariff expectations of much higher inflation. That's what I think has changed. The Fed has cemented that by saying, look, we're not going to cut rates because the economy's weak. We need to see evidence that there isn't going to be sustained high inflation. They're not going to get that in June or July. We only got 20% they're going to cut rates in May. I don't think they're going to pull it in June or July. I don't think they might even pull it in the rest of the year. So as the economy weakens, you have to make the case that it's got to weaken so much that it offsets the increase of prices of tariffs, then the Fed could cut rates. That's going to take a while to do. So what is the state of the bond market? It's focused on an expectation of high inflation that has surprised everybody. And that's what's changed the dynamic in the last couple of weeks. And I might add, if that continues to change it, I still would contend that really the stock market is taking its lead off of two things. One, whatever tariff announcement comes out every hour, it seems like, and two, what yields are doing. So if yields are going to stay sticky or higher because of these high inflation expectations, who's going to buy bonds if inflation is going to be high and the Fed's not going to cut because of that, that's going to really put a limit on how much the stock market can rally.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Bianco Research, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again and have a great day.